Good morning, or good afternoon as it now is. Everybody, thank you for joining our presentation on CT Private Equity Trust. This is a presentation of the third quarter results, so the 3 months to the end of September this year, and we will touch on progress in the year to date in the first 9 months of the year. So a couple of quick things to mention before I get into the presentation. We have had basically a quiet couple of years in private equity in terms of growth. That followed 2 very strong years prior to that. We so far this year, we're basically about flat in terms of NAV. We were slightly down in this quarter. Most of that was due to adverse currency movements. We were actually up in underlying terms. And that is the first 3 quarters worth. Bear in mind that the third quarter numbers basically are largely based upon June valuations, because we have very few September valuations when we compile the number, and we still haven't got very many. So the final quarter, which will give the full year outcome, that will be released at the end of March next year. We'll essentially have 2 quarters worth of valuation movements in that number. So that's worth bearing in mind. But I think we can get a good sense of how things are going so far this year. I'm just going to take you through the slides. The presentation should probably take a little bit more than half an hour. I go through fairly quickly to give maximum time for questions afterwards. Just to recap, those of you who are not familiar with the company, it is a private equity fund of funds with nearly half the portfolio invested directly into private companies through co-investments. We focus on the lower mid-market buyout sector in Europe, with most of the portfolio invested in continental Europe and in the UK. And we have a small amount in North America. We, as I mentioned, have a significant component in co-investments. The target is to get to 50%. We're slightly below that at present. And we like to back emerging managers. So these are up and coming private equity groups. We think that the alignment of interest between us as investors and they as managers, and also with the underlying management, is very close in that tier of the market, and that has worked out well for us. The company has been going for over 25 years. We have a very strong track record at or close to the top of our peer group, and I've been involved managing the portfolio throughout that entire period. So just looking at the numbers that we've just announced this morning for the third quarter, the NAV total return down 1% gives a year-to-date number of down 0.2%, so essentially flat to all intents and purposes. On a 12-month basis, we're actually slightly up 1.7%. Now, in the quarter, we had an adverse impact from exchange rate. Essentially, the pound has been strong against both the euro and the dollar, and we have about 60% of the portfolio is either in euro, shadow euro, or dollar denominated investments. So when the pound is strong, that tends to detract from the sterling NAV. And during the third quarter, there was a negative impact of about 1.5%, and there was a negative impact in the first half of about 1%. So you've basically had about a negative 2.5% impact on the NAV just through currency in the year to date. So if we didn't have that, we would be up. And that has already reversed slightly in the current quarter, but it remains to be seen where we get to by the end of the year. As I mentioned a minute ago, the third quarter number is largely based on June marks rather than September ones. About 8% would have been September, so the vast majority still based on June. And we will therefore, when we come to the full year, we'll have essentially 2 quarters worth in 1 quarter, which is why the final quarter and the full year valuation tends to, quite often is quite a large movement. I mean, obviously it depends on what's going on in the underlying portfolio, but it can be quite a big movement. So that's worth bearing in mind. A couple of points to emphasize in these numbers. We had realisations in the third quarter of £42.2 million, which is quite strong. New investments of only 9.3, so that's smaller than usual. The realisations in the year to date are running at £94.5 million, which is up about 75% on the equivalent period last year. And so, we would expect this year to finish with a very strong outcome in terms of realizations. Now, that is basically a good thing, because there is a reasonable correlation, a good correlation as you'd expect, between realizations and NAV growth, because exits are generally at a significant premium to the immediate carrying value. So although it doesn't always, the periods don't always coincide precisely, if you have strong realizations, you're likely to get strong returns. The dividend is maintained at 7.01 pence. Just to remind you, the dividend is paid out in 4 quarterly payments. Each of those is 1% of the average of the previous 4 quarters NAV. If that number comes up to be a number below the previous dividend, we just maintain the previous dividend. And with this kind of flattish period we've had, that is exactly what we're doing. We're maintaining the previous dividend, 7.01 pence, which means that the 12-month dividend is just over 28 pence, which gives a yield on the current share price comfortably over 6%. So just moving on to some of the events of the quarter and of the year to date. We've made one new commitment to a new private equity fund in the quarter. That's Inflection Enterprise Fund 6. Those of you who follow the company will know that we have a number of investments with Inflection, both funds and co-investments. We've been backing them for over 20 years. They are the sort of doyen, if you like, of the mid-market in private equity in the UK and increasingly in Europe. Very successful firm, very strong returns, and we will continue backing them as long as they continue to deliver great returns. They've got 3 sub-franchises, if you like. So there's the main buyout fund business, and they will make investments up to about 400 million in those companies. So proper mid-sized companies. They've also got a partnership capital fund where they will invest in minority positions. I mean, they will still have a high degree of control, but they typically have less than 50% of the equity, and that franchise has worked well for them. And then they have the enterprise funds. So the enterprise funds are looking at companies where the enterprise value of the companies is between 50 and 150 million, which is very close to our own sweet spot for our entire portfolio. And it's also where Inflection started out from, and they've got a very strong record there. So very pleased to be backing them again. Just recapping on the major exits that we've had in the year to date. Some of these I've mentioned in prior quarters, so I'll just restate it briefly. So Jolly's, which is a pet shop chain, it's a large format pet retailer. It's the second largest behind Pets at Home. This is a deal that we invested in alongside Kester Capital in 2018. It has grown very nicely over that period. It had various things to cope with. I mean, it had COVID, but that turned out to be a good thing for pet shops because they were allowed to stay open all the way through COVID. They've modernized this business where they bought it. When they bought it, it was a previous family business run by its finance director who bought the business, and there were a lot of professionalization measures that Kester were able to implement. Centralized buying, which amazingly hadn't happened before, plus a new third-party distribution system, and various other improvements to the estate of stores, and in fact they increased the number of stores from 60 to 100 over the holding period, and the business has grown very nicely over that period, and we made over 4 times cost and a 27% IRR when it was sold, and we got the money in April this year. So, you know, in some ways a bit of a traditional company, chain of stores, but growing very well, modernized very nicely. It was bought by TDR Capital, by the way, who own a significant stake in Asda, so they'll probably do something with Asda. Second exit here is Coretrax. This is a deal led by Buckthorn, who are energy specialists. Coretrax is an Aberdeen-based business that is in the oil services sector. Specifically, it's wellbore cleanup, plug and abandonment technology. What does that mean? Is basically a technical piece of equipment that goes on top of the wells. It caps off the wells, controls pressure, that kind of thing. There's an element of counter-cyclicality here, because as oil wells are decommissioned, particularly in the North Sea, you do actually need their technology to do that safely, but you also need it when you're doing new exploration. And they, during the holding period, acquired an American business called Mohawk, which allowed them to expand significantly into the American Permian Basin, the major oil presence there, oil province there. This was acquired through the sale. It was sold to Expro, which is a listed New York listed oil services company. It used to be a British company. We actually backed this many years ago through Candover, but it's now a much, much bigger business. And they bought it, and most of the consideration was in shares. Those shares have now been sold down. The final return, 1.7 times cost and an IRR of 11%, which is a bit suboptimal for us, but it's not a bad return considering the volatility in that sector over the holding period, with quite big fluctuations in the oil price. So we'd regard this as a reasonable outcome. Third major exit was ATEC. ATEC is an insurance company. It's a broker, but it also has its own managing general agent. So they place underwriting with a panel of insurers. They specialize in a niche of the market, which is caravans, small boats, beach huts. And that's a very sticky business, because once somebody has got the insurance for their boat or their caravan, they tend not to sort of shop around in the way they might do with car insurance. This business has been, again, very professionalized under Kester Capital. The various portals, the route to market, the digitalization of it has all taken place, and it's grown very nicely. The gross written premiums have gone from under 25 million to 75 million during the hold period, which is 7 years. And its profitability has essentially gone up fourfold during the holding period. It's now been sold to Perwin. We've got the money in September. Not allowed to tell you exactly how much we got, although you could probably work it out by looking at our RNS statement, but it's comfortably over 4 times cost. So that's a great outcome. This is the chart just showing you the long-term progression of our NAV and the cumulative dividends, which has been pretty good. Obviously, it's been relatively quiet in the last year or so, but the long-term trend, which we think will be resumed fairly soon, is very positive. And this is the share price and NAV over the entire company's existence. We've been going for 25 years. We had our 25th anniversary earlier in the year, complete with a sort of party at the stock exchange where we got to press the closing bell, or buzzer. It's a buzzer actually, which was good fun. The important point is, if you look at the returns here compared to the stock market, that's the all share index, which is the grey dotted line. It's miles in excess of what you would achieve in the stock market over that 25-year period. The gains that you would have made had you bought our shares and held them are over 4 times what you would have made if you just invested in the all share index. And therein lies the argument behind investing in private equity and staying in private equity. There's still a gap between the share price and the NAV total return. Now that gap is wider than it usually is, and I would suggest that's a good opportunity for those of you looking to add to your holdings, because that gap will narrow. Looking at 5-year fund performance, various statistics here, which shows you that, as I said earlier, you've had some pretty punchy years in 22 and 21, much quieter in the last couple of years, but hopefully that will change once we get through this phase of adjustment that's taken place in the private equity world. Private equity world is still growing, by the way, and we're still making positive returns. We have not gone X growth, far from it. This is the outstanding undrawn commitments. Now we need to make these to make sure that we can maintain a fully invested portfolio, but the commitment level is very comfortable. It's bang on the 5-year average at 39% of NAV, so nothing out of the ordinary here. And debt has come down a bit. We had about 90 million of debt last quarter, but it's now gone down to 70 million. We think we're in a very sort of comfortable zone. It's about 12.6% geared at the moment. Typically, we're sitting between about 10 and 20%. If it's up towards 20, that's on the high side, and it tends to be temporary, and we bring it down. If it's below 10, it's a bit low, and therefore not going to make much of a contribution to returns. So current range is fine. We've got more than half our revolving credit facility available to use. You need to keep a bit of headroom in it, obviously, but we've got plenty of scope there. I mean, just going back to that, I mean, the long-term argument is that the returns that we expect to make by investing in private equity are going to be far in excess of the cost of debt, even with debt at a higher price than it has been for a while. This is just the investments in 2024 to date. I'm not going to go through all of these individually, but they are, diverse by geography and sector and lead manager. We're always renewing the portfolio. These are some of the recent co-investments, which I will just touch on. Some of you have heard of a few of these before, so I won't labor the details. Cyclomedia is it's a Dutch-based company that essentially maps areas using a LiDAR technology, and the maps are used by generally local authorities for the purposes of local taxation, so business rates, that kind of thing. Started in Holland, moved into Germany, moved into the US, and it is essentially a unique proposition, and it's growing nicely. The deal is led by Volpi, whom we've invested with for many years, and it's got off to a good start. We've been in it for over a year, and it's nicely up already. This one is Utamaco, which is led by the German house SGT Capital. This provides security tokens and cyber security services. So this is a strongly growing market, as you can imagine, growing at double digits, and they already have a 5 to 10% global market share, which is growing. So that's one of the devices there on the side, and this has also got off to a good start. This is another, quite a technology theme here, actually, but that's the world we live in. I mean, technology is omnipresent. This is BrainCube. This is a software company. It provides software for manufacturing processes. So it already has a blue chip list of clients. It's a French company. The software essentially improves the manufacturing process. It makes things faster, less waste, less energy usage, that kind of thing. The deal is led by Scottish Equity Partners, the growth equity investors. We know them very well, obviously, because they're based in Glasgow, and I've been backing them since 1996. So we've got a very good idea of their capabilities, and really confident that this will work well for them. And then Educa EdTech, which is led by the Spanish group Orica Capital. This is an online training company, essentially. It provides professional qualifications, master's degrees online, largely to the Spanish-speaking world. It's obviously started in Spain, but a lot of its customers are in Latin America. This was bought quite a low price for this type of company. We got in at below 7 times EV to EBITDA, which is sort of unheard of for this type of business, but mainly because Orica had a good local angle on it, and so that's also doing well. Then we've got Accounts IQ. This is accounting software for smaller and medium-sized companies. It's a bit like Sage, but much smaller and probably more sophisticated. And this deal was brought to us by Axiom. So Axiom are an emerging manager that we've been backing for the last couple of years. Their team come from Inflection and from HG Capital, one or two other places, and they specialize in software and technology enabled businesses. And this one is the first deal we've done with them. So plenty of opportunities for new deals. We see a very good flow of co-investments. This is actually the realizations in the year to date. You can see the multiples and the IRRs and the sectors. They're very diverse sectors, different countries, different lead houses. Quite a strong technology-oriented theme. Don't apologize for that. This is where people invest in private equity these days. These are mature businesses that are all profitable, good revenue growth, profits growth. This is not sort of loss-making venture capital funded solely by their equity. These are real businesses, and therefore people want to buy them, and therefore we make good returns. And there's a few more of them on this page. We're obviously rejuvenating the portfolio all the time. Lots of new companies going in to the portfolio. Again, these often have a sort of information technology or healthcare angle, but not all of them. I mean, we've got restaurants, chains, and other things connected to the consumer and industrial sectors. But there's a lot of software and healthcare, because collectively these two sectors account for about half the portfolio, and has been a good driver of growth and gains for us. This is the long-term pattern of distributions and drawdowns. You can see we actually had a lot more distributions and drawdowns this quarter, which is basically a good thing. But you can see how that fits into the long-term pattern. The co-investment element we can control directly. We didn't actually do any co-investments in the last quarter, so that did help in terms of the balance sheet. On the largest underlying holdings, a couple of things to watch out for. Sigma, which is a US-based electronic components company, we expect that to get out of that in 2025 actually. So that has been in the portfolio for a while, but it's going reasonably well. New entrant at number 2 is OHI. This is a helicopter company in Brazil. We have this through Sterling Square. We've been in it for quite a long time. It's quite a large company, which is reasonably successful. They've been trying to sell it for ages, and it's proving hard to sell, not because there's anything wrong with the business, but just because buying helicopter companies that service the oil industry is not everybody's cup of tea at the moment. And the alternative of doing a listing in Brazil, as you can imagine, is quite a difficult thing to achieve, and it does need the right market conditions, which aren't present at the moment. Number 3 is Weirdfish, our clothing company. Some of you may have been at our Capital Markets Day in October, where we had David Butler, who's the new chief executive, presenting on this one. So this business is growing quite nicely. We may be able to exit this next year, I'm not sure, but that's a possibility, which would be good. TWMA, this processes drill cuttings from oil rigs. This suffered a bit during COVID. It was difficult to mobilize their equipment and get it out to the various different provinces. So it's still at 1x cost, but I think Buckthorn are trying hard to sell that at a premium, hopefully next year. The 5th one is San Siro, or Hoffi, which is our funeral homes business in Italy, which we're largely out of. We've sold 3/4 of it. We've held on to a quarter. So this quarter is still worth 10 million. I mean, we've made 8x our money already on the original deal. So that's going pretty well. Aurora Payments is an American payments company led by Corsair, which is still quite early in the holding period. We've still got a bit of work to do there, but it's going okay. Utamaco and Cyclomedia I've mentioned to you. 9th is Cyberhawk, which is our Livingston-based drone company, which has been doing really well, building out its client base, mainly in the energy sector. And we're optimistic that will be able to be exited in 2025. And then we have Breeze, which is the essentially makes sophisticated fume cabinets. That's still in a build-up phase, still quite early in the holding period. So lots of interesting things there. The top 10 holdings only account for about 20% of the portfolio. So lots of other things well below these, which have got great prospects as well. In terms of the geographic and vintage year split, this hasn't changed significantly, 42% in the UK. This is a far higher exposure to the UK than any of our peers. Most of them have hardly got anything in the UK. I'm talking about the fund of fund peers, and we still think there's a lot to go for in the UK. It's a good thing. Hopefully Rachel Reeve is listening to this and noting it, that there are people that already do put a lot of their money into the home market, and we're one of them. Most of the rest is in continental Europe, although we have a significant 17% position in the States, because we've got some excellent relationships and investments there. In terms of vintage year, we have a steadily maturing portfolio. More than half the portfolio is over 4 years old, 60% over 3 years old. The usual investment thesis is around a 4-year hold. Normally, in actual fact, it turns out to be a wee bit longer than that. But after 3 or 4 years, you are preparing a company for sale. So the proportion that's over 3 or 4 years old is a proxy for your stock of future realizations, and we've got plenty coming down the track. In terms of the valuation, it's on an enterprise value to EBITDA basis 11x. Again, this is quite a lot lower than our peer group. Many of them are much higher than that. And the entry enterprise value to EBITDA of the current portfolio is about 8.7x, which is in line with our long-term average. And it is actually a really good, if you can buy a business, a good quality growing mid-market buyout in Europe now at 8.7x, you're doing pretty well. Not very heavily indebted, just over 3x debt to EBITDA. So underneath all these holdings, you don't have lots of precarious gearing. I mean, you do have some gearing because they're management buyouts, but it's not particularly high. So the capital structures are not risky. This is the sectoral split. As I mentioned earlier, nearly half the portfolio is in healthcare and information technology, but we have got significant amount in consumer discretionary, industrials, business services, as you'd expect. The portfolio is deliberately well diversified because private equity is naturally risky, and the only reliable way of reducing that inherently high risk down to moderate levels is through building and holding a well-diversified portfolio, and that's exactly what we have here. So to conclude, the portfolio is broadly based, it's very resilient. Nearly half the portfolio is in these long-term growth sectors of information technology and healthcare. We're seeing excellent deal flow, and in most of it's at good prices. And pricing has moderated a bit recently. You tend to get this when you have a quiet phase. If you're having a quiet phase, which we did have until about earlier this year, it means that buyers and sellers are not coming together because prices haven't adjusted. Pricing is now adjusting, and hence we're seeing a big increase in realizations. We're up, by 3/4 on last year, and that we'd expect to continue into the final quarter. We've got plenty of borrowing facilities in place, which allows us to take opportunities whether or not they're funded by realizations. More capacity, we've got better covenants, so we're in a good position to continue to build the foundations for future growth. And with this big uplift in exits, it's very healthy, and there's a good uplift on exit over the previous carrying value. It was 22% on a weighted average basis year to date in 2024. It's a little bit below the premium last year, but I think that will build as we go further into the year. Lots of people want to invest in private equity. It's an excellent long-term asset class. It's got a very strong record of delivering returns, and indeed our company has as well. And as we come to the end of 2024, look into 2025, we're very confident we'll continue to grow value for shareholders in the short and medium term and longer term as well. So that's the end of the formal presentation. I think we're about 35 minutes in, so we've got a bit of time for questions.
Yes, Hamish, thank you. It's Peter Brown here from the Investment Trust Sales team. We've got a few questions come in. We'll try and run through them as quick as we can, but obviously give some good, thorough answers as well. The first one was a pre-submitted question regarding the discount. You did mention it, and the fact that it is a very good opportunity to buy assets at a depressed share price. But there was a little bit of disappointment from shareholders that the share price hasn't sort of moved up in line with NAV. What are we doing about the discount, and can we get that tighter in the near future?
Yeah, well, people saying what am I doing about it? I mean, I actually can't magically eliminate the discount just by thinking about it. We basically need to encourage new buyers of the shares, and pointing out the conspicuous value that there is there at the moment is one of the things that we're doing. We're upping our marketing, our PR. I mean, our target market are wealth managers and other forms of retail investor, but we also appeal to institutions as well. The discount should narrow as NAV growth picks up again. We've done some buybacks. We've been quite active buying back earlier in the year when the discount was about this level. We're not going to use tons of the company's capital to do buybacks because that would have an impact on the balance sheet, but we will where we think it's going to be helpful to the share price. For example, if there's a big loose line of stock coming out, we will and have used our buyback powers to do that. It gives a nice enhancement to NAV, but the amounts of money involved are quite small. So basically encouraging new buyers for the shares is the most constructive thing we can do. I don't believe there are clever discount protection mechanisms that work over the long term. It's very much my ambition to make sure this company is much better rated. And we have been at a premium in the past, not often, but a couple of times in the company's life. And my sort of sincere ambition is to get us up there again so that we can actually issue stock. And once you get into a position where you're at a premium and you can issue stock, you can tend to the other side of it is you can tend to buy back quite regularly and maintain that premium rating. None of my peers are on a premium rating. I mean, most of them are on at least the same type of discount that we're on. Typically, we've had a narrower discount than the peers because our dividend is much better and probably more reliable than theirs. And so, I think we're slightly anomalously cheap at the moment. Well, we're significantly cheap, but we're anomalously cheap compared to some of the others.
Yeah, thanks. I agree. I think that the sector itself is on quite a big discount, and it's difficult to stand out from the crowd. But going back to the NAV, we've got a shareholder here that's happy with the steady dividend, but keen to see improvements in NAV growth and new investments. Obviously, you've mentioned about the last 12, 18 months being a fairly stable but unremarkable period for that. What steps are planned to boost the capital growth and NAV performance?
Yeah, as realisations pick up, and we've seen them begin to pick up quite strongly this year, that will drive NAV growth. I mean, it doesn't necessarily happen immediately, but it will drive it. Underlying profitability of the companies ultimately comes through, and we don't have the numbers for the first 9 months of the year, but from the presentations I've been at, underlying profitability growth is good. I mean, it is very robust. It has been all the way through. So ultimately, that will exert itself, and you'll see NAV growth, and therefore, share price growth will come through. We're always laying foundations for growth. So at any given point in time, you've got quite a bit of new investment in the portfolio. Now that takes time to deliver, growth in NAV, but it does come through. And if you look at our long-term record, you can see that it has come through very steadily over the 25 years. So, be patient, and we will deliver.
And staying on an NAV theme, a question comes in: what explains the discrepancy between EBITDA growth and NAV growth? Shouldn't the NAV grow in line with EBITDA growth?
Well, it would if the valuation multiple was completely stable all the time. It has been under a bit of pressure in the last couple of years, so that's one of the reasons where you may get a bit of a discrepancy. But over the long term, you will get NAV growth, which is closely correlated with EBITDA growth. It won't be exactly the same, but it'll be closely correlated. And our companies are delivering good EBITDA growth, so this is why I'm confident about the medium term.
We can't go very far without talking about the UK budget, unfortunately, possibly. But do you believe the government's decision to increase employer national insurance contributions from April 2025 will impact the value of much of the UK part of the portfolio?
I don't think it will impact much of the UK portfolio. There are individual companies where it's more significant, particularly those that employ a lot of people. So we have got quite a few companies that are in the sort of the care sector. Sensitivity to wages and inflation, etc., is one of the things that we consider when we go into these businesses. I mean, what will happen is that they've all had their costs go up quite significantly, and so they will have to pass that on in increased prices or fees that they charge, which may end up being inflationary for the economy, but that will be their natural reaction. And to the extent that the end customer is the state, which is in some of these companies, the government's just making a rod for its own back. I mean, it's pushing up costs, are pushing up minimum wages, and those wages are then a lot of them are having to be paid by the public sector. So it's a bit of a circular trip. Many of our companies have got very substantial margins, particularly in the software area, and they don't have much in the way of employees. So without sounding like I'm saying I'm all right, Jack, I mean, it is not it's not a good thing, this, but it's not a disaster, far from it. We've got a well diversified portfolio. I mean, it's not good. I mean, as anybody who's been following current affairs for the last few weeks will know that there's been a big backlash from industry over this because they weren't anticipating it. And it's quite a blunt instrument. It adds to the costs of every organization that employs people. It's not a tax on profits, because this is just adding to costs, which is actually, all things being equal, reducing profits. So obviously, if I'd been the Chancellor of the Exchequer, I would have found other ways of raising the money, but fortunately, I'm not.
You've got enough on your plate with your day job, I think.
Yeah,
Could you give some market commentary, please? Where do you think the best opportunities are at the moment? Is it primary, secondary, or co-investments?
well, I mean, there are opportunities right the way across that. We tend to find that the secondary market, which we are quite active in because we have two separate secondaries fund, is quite cyclical. The price that you can achieve does fluctuate a bit. I think it's improving in secondaries. Actually, I've seen some quite interesting pricing being offered. Co-investments, we see a steady stream of opportunities, as we do in primaries. We're in a stage in the cycle where we've come out, or we are coming out of a kind of, it wasn't really a recession, but it was a kind of weak period. The last quarter's GDP growth in the UK wasn't brilliant, but before that, it was quite obvious we were having a recovery. And when you invest in the wake of a weak period, you tend to buy quite well, and that opportunity will persist for a bit, and then those businesses grow into a sort of strengthening economic background. And so I think now, or over the next year, 18 months, will be a really good time to be making new investments.
Okay, lovely. There's a question about the Capital Markets Day that you mentioned. Is there a recording available if you missed it? I think I could probably answer.
I think it's on the website. It's on the website.
Yeah, exactly. There are certain snippets on the website, so certainly go to the CT Private Equity in Columbia Threadneedle's website, and there'll be quite a few videos there. There won't be the full session because obviously it's about 2.5 hours long, but there's certainly material that's been put on the website for you.
Yeah, I'd encourage you to look at that, because apart from me rabbiting on, you get to hear from the management of some of the underlying companies, and you also get to hear from a number of the other members of my team.
You mentioned private equity as a sector invests more and more in technology. Is that a function of the available opportunities, or is there a risk of herd mentality?
Well, good question. I don't think it's herd mentality. I think it's just because technology is becoming, perennial and pervasive across the economy in the modern world. We saw a lot of, acceleration of the digitalization of society during COVID for obvious reasons. We also saw the importance of good health, and healthcare was highlighted during that period as well. So that probably gave a bit of an impetus, but it was really an impetus to something that was already going on, because private equity likes to invest in sectors that offer secular growth, where there's a trend that lasts more than a few years, and you can see it going forward, because even if you can't predict it really accurately within a year or two, if you're over a 5 or 10 year period, some of these trends are very clear. So provided you don't overpay badly, you'll probably do quite well. And also I think private equity has become more clued up in terms of the technologies. The expertise across the sector is quite a lot deeper. I mean, in the old days, the classic private equity guy saw himself as a bit of a natural deal doer. They just thought they were naturally geniuses at negotiating deals. Now that is only one part of the skills that you require. Actually knowing and understanding the technologies and the dynamics of technology-oriented companies is, in my view, just as important as being able to decide whether something is cheap or not. And a lot of these companies that we go into, I mean, some of them are so complicated that you really have to spend a lot of time trying to work out what they actually do. And I have a simple rule, which is if I don't understand how they make money, or my team can't understand it and explain it to me, then we won't invest in it. But fortunately, I've got some quite clever people in the team, so they're generally able to do that and to articulate the opportunities. So I think we'll see more, not necessarily a bigger percentage, but we will see many more technology-oriented businesses coming into the portfolio over the years.
Okay, there's a couple of questions on dividends. Obviously, we're proud of the dividend, and it's a big part of why someone should own this trust. I'll merge two questions together. If realisations dried up, would you use gearing to fund dividends? And the second question is, can the current dividends be maintained over the next 3 to 5 years?
Yes, the dividends can be maintained. The dividend is set at a level that we are very confident we can pay under just about any foreseeable circumstances. So it costs us £20 million a year. The portfolio is over 500 million in gross terms. So it's going to generate a lot more than £20 million a year, and a bit more to cover our expenses. So we've set it at 4% because we believe that's a level that we can maintain, come hell or high water, really. So the situation you're asking about, if we had less than 20 million of realizations, would we use gearing to pay the dividend? Well, the answer is probably yes, but I think it's a very unlikely situation for us to be in. If we are in that situation, that would mean that we have probably mismanaged the company, and we don't intend to start doing that now. What was the other bit of the question, Peter?
Well, I think you've answered it. Would you use gearing, and is the dividend sustainable over 3 to 5 years?
Yeah, it's definitely sustainable. It's been set at a sustainable level. When we put that dividend policy in back in 2012, we looked at different ways of allowing our shareholders to benefit from the realizations that we would always have coming through, and we could have done tender offers. We could have done, irregular special dividends. We could have said we'll distribute a set proportion of realizations. The problem with those things, apart from being quite complicated, they were quite difficult to make. It's quite difficult to make sure that all shareholders benefited from them, and also the amount that we were going to distribute would be very difficult to predict. Even I would find it difficult to predict one quarter to the next what the exact realization total would be. But with our current dividend policy, at any given point in time, you're only missing one piece of information, which is the final quarter's NAV. And even if you don't know that, you know for sure that the dividend will be at least the level it was in the previous quarter. So it's highly predictable, and basically, our investors like that. They can predict. They know that they're going to get their quarterly check, and they know the minimum size of that check.
Two questions that I'm going to merge together, but bizarrely they're sort of counteract each other. One is equity markets have been very strong this year. Why have private equity funds struggled to grow NAVs in this environment? And the second part is, what explains the long-term outperformance of private equity in your opinion? Is it likely to continue well into the next decade?
Well, the long-term performance of private equity is because it's got a very strong alignment between investors and management, and when you've got that alignment of interest, it tends to work. So the management of the companies, who know about running these companies, they benefit when there's growth. The private equity managers benefit. The underlying investors, us and you, also benefit. They do their research up front. It's a very research intensive. They're operating in a market where the information they're gathering is not public, so they have a natural advantage over anyone else. And the trick in private equity is to find out information that other people, well, it's to find information other people don't have, and then to draw conclusions from that information that other people haven't yet drawn, and then to do that consistently. And you provide capital to management buyout. So, quite often the key determinant of whose capital they receive is the management team of the underlying company, and they've got a very strong eye on not just the price of that capital, but also what comes with that capital, the expertise that comes with it. Because if you are Inflection, you've done dozens of deals, and the management of those companies have all made good money personally, a management team will see that, and they will think, I should have the money from Inflection, because they'll bring expertise that will allow me to grow this business rapidly, and I'll make a good capital gain for myself. And so they will not necessarily source the cheapest capital. The cheapest capital might come from some faceless bank who've got no expertise. And so if they need help growing the business, they won't be able to give them any help. They'll just be asking them for, the interest payments. So private equity is capital that comes with expertise. And if you are good at private equity, you will be able to win deals where you are not offering the cheapest capital. In other words, you'll be getting in at a good price. And if you do this often enough, you have a sustainable advantage over other people, which is why there's persistence of performance in private equity, which is very rare in other asset classes. So you've got inefficiency, expertise that goes alongside the capital. Very few companies, as a proportion of all companies, actually receive private equity. So there's a massive sort of sifting exercise. There's a cherry picking exercise that goes on. And that's why private equity outperforms, and it will continue to outperform. And our company is one of the ways that you can get that exposure immediately and simply just by buying shares.
I'm getting close to the hour now, so I think we'll make this the final question, but it's quite an interesting one, I think. 10% of the portfolio value is 2016 vintage or older. Can you speak a little about the kinds of investments in this bracket and why exits haven't been made to date?
Yeah, so funnily enough, not every investment that we invest in works out 100% according to plan. So sometimes they have to have a second or third plan, and that sort of older part of the portfolio, that's normally what that is. It's normally where the original plan, which had been based around a 4 or 5 year hold, has not been implemented for whatever reason. It doesn't necessarily mean the company's been a complete failure. It may just mean that things have taken longer than expected, and so they can have they regroup, they replan. Where there is actually value in our valuation, it means that these are live businesses, and where there is good prospects. Now, we did an analysis. I haven't got all the details in my head, but we did an analysis looking at the sort of rump, if you like, the older bit of the portfolio. What happened to that? Did it actually ultimately become realized, and what were the returns from that bit of the portfolio? And the interesting thing is that most of these companies were returned with nice positive returns. The IRRs were lower than the core part of the portfolio, but they weren't bad. They were quite reasonable. They were in the sort of teens. So that is definitely worth managing and hanging on to. If the companies were real kind of dross, which I think is probably what you're thinking, they wouldn't have any significant value. They would have been written down. So there are companies and funds that have a sort of late period blossoming, and that's what that bit of the valuation represents.
Lovely. Okay. Thank you, Hamish, and thank you everyone for your questions. We will get round to answering all questions that haven't been asked on the website. So check in for the next 48 hours, and hope you're getting answers to the questions that haven't been answered today. But Hamish, if I can just ask you for some final comments on the trust.
Yeah, I think we've had a period of adjustment in the private equity market in the last couple of years. I think we're coming to the end of that now. We're seeing good signs with the increasing flow of realisations. At the same time, we see a good flow of new opportunities to invest. So I think we're getting into a period where normal service will be resumed in 2025. We're excited about it. I think the opportunities for people to add to their holdings now are obvious. One of the points I didn't make earlier was that when the market goes into a kind of risk-off mode, discounts and private equity trusts tend to widen. When the market goes into a risk-on mode, they narrow quite significantly, and that also tends to coincide with a upswing in realizations and pushing forward in NAV. There's some evidence that that risk-on attitude has taken root in America already, and what happens in America tends to spill over to here. So I think that's something else that's worth bearing in mind. But the fundamentals of this business are strong, and we're sure it will continue to deliver growth for many years to come. Thanks very much indeed for your time, and thanks for your questions.
Hamish, Peter, thank you for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CT Private Equity Trust PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.